Welcome everyone, and thanks so much for joining us, especially as it's a few weeks later than we originally intended. So to get us started, let me introduce myself. I'm Karen Barker. I'm Head of Policy and Research for Aberdeen Financial Fairness Trust. We're an independent charitable foundation focusing on improving living standards for people on low and middle incomes. And we funded the research being launched today from Nest Insight. So we were founded with a substantial donation of unclaimed assets from the demutualization of Standard Life. So that legacy, combined with our focus on living standards, means that pensions policy is a key area of interest to us. So we were delighted to fund this project from Nest Insight. We know that even after the success of auto-enrollment, too many of us are still not saving enough towards our pensions to ensure financial security in retirement. And we felt that this project, aiming to explore practical options for how employers can better support their employees to save into their pensions contributions, would make an invaluable contribution. So, now we find ourselves in a very different economic context than when this project began in the summer of 2021. Employers are facing huge pressures, whether that be uncertainty over energy price rises or calls from their employees to raise wages to help them cope with rising living costs. And pension funds have certainly been in the news far more than usual the past week, even though issues of fiscal policy are definitely beyond the scope of our conversation today. I think it's worth mentioning because it highlights the unpredictability of these times, which obviously presents huge challenges to employers. So given the enormity of these challenges, some might question whether now is the right time to be asking employers or employees to think about something as long-term as pensions. And it is a fact that many households are facing a very difficult winter. But it's also true that households that aren't on track for a livable pension may face financial insecurity that could last decades in later life. So that's something that we need to continue to pay attention to. But that being said, before too much gloom descends on us for a Monday morning, I think it's important to say from the outset that I think this research from Nest Insight is actually very hopeful. It shows that there are actions that employers can take to support their employees to save for their pensions that aren't going to break the bank. And we'll be hearing more about that later. So to kick us off, I'm thrilled to be joined by an expert panel for this session. They're going to introduce themselves as we come to them in the session. And first off, I'm going to be handing over to Felicia, who's going to outline the scale of the problem that we're trying to solve here. So over to you, Felicia.
Hi, thank you for that introduction, Karen. Yeah, this is really important work. So I'm Felicia Dampton. I'm an economist at the Resolution Foundation, and I have been working with the Living Wage Foundation on a living pensions report, which we released earlier this year. So I just wanted to thank Nest for inviting me to speak and the Living Wage Foundation for commissioning this important work. So in my presentation, I'm going to take you through a few results from our living pension report, starting off with the background and context for this project, then take you through some key findings and what might be the drivers behind them. There are a few complex slides, but don't worry, I'm going to try my best to take you through them and make it as easy as possible to understand. So let's get started. There have been some big policy changes in recent years to help boost pension savings amongst workers. So from 2000, there have been a decline in the amount of people saving towards a pension. And then in 2012, the government introduced an auto-enrollment policy. This auto-enrollment policy automatically enrolls employees earning £10,000 or more annually to their workplace pension scheme. So the chart that you can see here shows the proportion of employees with a workplace pension over time. As you can see, prior to the introduction of auto-enrollment, the number of employees with a workplace pension was declining. However, once auto-enrollment was introduced, this massively shot up, proving just how successful the policy has been. But now that people are saving towards a pension, the question is, are they saving enough? And this is something that we've been investigating with the Living Wage Foundation. The living wage has been really successful in improving pay for thousands of workers by providing a clear benchmark for wages, which provides an acceptable living of standards for workers. And building on the success of this, they wish to develop a parallel standard, the living pensions, which would set a clear benchmark for the rate of saving required for workers to afford an acceptable standard of living in retirement. A previous feasibility study conducted by ourselves established a framework through which the living pensions benchmark could be calculated. And this was done in 2 stages. The first part was to establish a pot of income required for an adequate standard of living in retirement. This was based on important factors such as forecasted life expectancies, average household size, what homes people would live in, future policies on the tax and benefit system, etc. And then the next part was to determine the total annual contributions workers would need to make to accumulate this target pot. These calculations were carried out separately for different worker cohorts to allow for the fact that older cohorts would be closer to retirement and have less time to save compared to younger cohorts. Because of this, the study didn't settle on a single benchmark, due to the fact that different cohorts would need different targets. For this report, we compare the worker pension contributions to 2 key benchmarks. The first is an all-age benchmark, which refers to the average across all worker cohorts. In percentage terms, that's 16.2%, and in cash terms, that's £3,000 annually. The second is the whole career benchmark, which applies if workers start saving in their 20s and therefore have their whole career to save. In percentage terms, that's 11.2%, and in cash terms, that's £2,100. There are a few things to note. Firstly, the total pension savings here is a combination of both employee and employer contributions. Secondly, we've excluded self-employed and Northern Ireland from this analysis due to data limitations. And third, we also exclude defined benefit pension holders. It's also important to note that the benchmarks represent, on average, what workers would need to save to have an acceptable standard of living in retirement. Therefore, we're not saying who is or who isn't on track, since individual saving requirements vary. Rather, our analysis looks at the narrow question of who in 2020 was saving above the estimated benchmarks. So in the next set of slides, I'm going to present a few key charts and findings from the report. So who is actually saving above the living pension benchmarks? So this chart shows the proportion of workers with a pension saving above the whole career benchmark, which was 11.2% or £2,100. And as you can see, there's been some slight improvements over time with a slight uptick in recent years. However, if you look at the scale, you'll see that a large proportion of workers didn't meet the benchmark. So in 2020, only 17% of workers met this benchmark, meaning that over 80% of workers didn't. And now as we compare to the all-age benchmark, we see that there's even less proportion of workers meeting the benchmark. In fact, it was only 9% in 2020. But it's important to note that this varies amongst high and low paid workers. So we see that the situation is even worse when we compare to low paid workers. Less than 5% meet either the all-age benchmark or the whole career benchmark. But why aren't workers meeting the benchmarks? Essentially, we believe it's a combination of 2 things. One, because there's still a large proportion of workers who aren't saving, and 2, people who aren't saving just aren't saving enough. So I'm going to break this down over the next set of slides. On the left-hand side is the first part of the chart, which looks at the amount of non-savers over time. So that's from 2012 to 2014, 2015 to 2017, and 2018 to 2020. And then after that, on the left-hand side will appear a chart that looks at will look at the proportions of people who are saving at different rates across time. Please note that the colors correspond to the time periods that I just outlined. So looking at this chart at the moment, which shows the proportion of workers who aren't saving, it's really clear to see that though there have been improvements, there's still a lot of people who are yet to take up pension savings. But then, as we look to the right-hand side, we see that the proportion of workers saving by saving rates, so the color corresponds to the time period, and the bulges and the peaks of each distribution correspond to the most common saving rates amongst workers. Therefore, we can see that over time, there has been an improvement as workers are saving more, which has been in line with the increases of the auto-enrollment minimum contribution rates. Whilst this is good news that pension rates have been increasing, they are still far below the living pensions benchmarks, as you can see outlined by the black dashed lines on the graph. So what could be driving this? Essentially, we think pay is the main driver. The chart here shows the proportion of workers meeting the benchmark by hourly pay quintile. On the right is the whole career benchmark. On the left is the whole career benchmark, and on the right is the all age benchmark. And as you can see in both charts, there's a clear trend. The higher the pay, the more likely the worker is to meet the living pensions benchmark. For example, only 4% of workers in the bottom fifth meet the whole career benchmark compared to 34% in the top fifth. And that's similar for the all age benchmark, where only 2% of workers in the bottom fifth of pay meet the all age benchmark and 20% in the top fifth meet it. We find that this is reinforced when we look across industry, which is shown here on this chart. We can see that across all workers for all benchmarks, there's not much those who are working in finance industries are much more likely to meet the benchmarks, and those that are working in hospitality or admin or working in admin services are less likely. To be more specific, those who are in finance are 5 times more likely to meet the whole career benchmark than compared to workers who are working in retail roles. The data also allowed us to look at gender differences. And as we can see that for both genders across both benchmarks, there isn't much of a difference between men and women. However, when we do take a closer look at the gender differences between low paid, we see that there is a slightly significant difference, which again just speaks to the fact that if you are lower paid, you're much more less likely to meet the living pensions benchmark. Our report goes into much more detail, breaking down this analysis by part-time, full-time, age, and region. But I'll leave you to read that report if you want to get some more info. So what are the key takeaways? The auto-enrollment policy has had a huge impact and has been successful in getting more workers to save towards a pension, especially those with low take-up, such as low-paid workers. But overall contribution rates among savers remain too low. And this particularly the case for low-paid workers means that they're at a greater risk of not receiving an adequate income in retirement. There's still much more work to do to ensure workers receive an adequate pension in retirement. Thank you.
Thank you very much, Felicia. That was really helpful to set out the scale of the problem that we're trying to address here. So now we're going to come on to Jo, and she is going to talk us through some of the key findings from this report that they are publishing today. So over to you, Jo.
Thanks very much, Karen. I am really excited to share this research into employer pension contributions. We did preview this at our summer conference for anyone who is in the audience there, but now the full report is available today with lots more detail than I'll be able to share, so please do take a look. Can I have the next slide, please? So although contributions going in are one of the most important determinants of pension adequacy for employees, we previously lacked a clear view of what UK employers are doing in this space. And indeed, it's a question that's raised in the research that Felicia shared just now. now that staging and phasing are complete and auto-enrolment is well established, we really wanted to get a handle on what's really happening when it comes to employer pension contributions. So I would like to thank Karen and the Aberdeen Financial Fairness Trust for supporting this work to allow us to get that much more comprehensive and up-to-date understanding of the landscape, including such kind of basic questions as how many employees are offered more than the minimum mandated employer pension contributions, and how do different employers actually structure their pension contributions. We also wanted to understand why things are the way they are. So how are contribution levels and structures decided? What are employers' motivations where they do go beyond the minimum? And what are the barriers to doing that where they don't? And finally, we wanted to look ahead. We wanted to understand the potential for evolution in this space. To what extent are employer contributions actually a lever for change, for improving employee financial security in later life? Are there different approaches or designs that would work well for both employers and employees? And how feasible would change be, and what are the most promising opportunities? So to do that, we've reviewed existing research and data, we've spoken to experts, and we've heard from over 500 employers in this research, as well as advisors and industry bodies. We conducted both in-depth qualitative interviews and also a nationally representative employer survey, which was conducted in March and April of this year. And I think it's really important to say that the employer sample was broad. So in some of the studies we reviewed, the focus was perhaps just on larger or just on FTSE employers, whereas our sample was representative of all UK employers and included those smaller employers who are often under-profiled when we look at this topic. Although they account for much of the employee experience, nearly half of UK employees work for a smaller employer, and I'm delighted that we've got Amelia here to talk about the small employer perspective as part of this discussion. Before I get into the research, I think it's really important to say that we're not looking to prescribe or recommend any one approach, or indeed to judge any employer. Employers have a diverse range of contexts and circumstances, and we've tried to reflect that context in the report as accurately as possible, so that we can fully understand and appreciate the employer side of the equation when we talk about pensions adequacy for employees. Before getting into the research learnings, it's worth remembering where we've come from. As Felicia's reflected, before auto-enrolment, there were big gaps in employee workplace pension experience, depending on who you worked for. So some employees got something and some employees got nothing. And as Felicia's shown in her charts, auto-enrolment has greatly broadened access to workplace pensions. And drilling below the surface of that, looking at these charts, we can see that that's particularly the case for those working for smaller employers, and particularly those working for smaller employers in the private sector. So we can see that particularly steep uptick from a lower starting point for those working for particularly small and micro private sector firms in the bottom chart in orange here. As you'll all be aware, but it's always useful to recap, UK pensions regulations require a minimum mandatory contribution level of 8% of a qualifying band of earnings, of which at least 3% must come from the employer. Both employees and employees can contribute at higher levels than that voluntarily, and that's really what we were looking to understand here. So as a result of this, most employees are now offered at least a minimum 3% employer contribution into a workplace pension scheme. And this was a really huge undertaking for many employers. It's a really great achievement and a really positive equalisation story, and I think it's really important to kind of set that as the baseline for this conversation. So what is the employer pensions contribution landscape today? And you know, we're 10 years on from the start of auto-enrolment. What is that landscape now? So when the idea of auto-enrolment was introduced, one question that was sort of quite often raised in the debate was whether those employers who were doing more than the minimum levels would level down as a result of auto-enrolment. And the first thing we can see in our research is that many employers are offering more than the minimum contribution levels post auto-enrolment. So we can see here that nearly 4 in 10 employees work for an employer who offers more than the minimum 3% employer contribution to all their employees, and a further 2 in 10 work for an employer who does that for some of their employees. And it's worth saying as well that employers are also boosting pension contributions in other ways. So around 4 in 10 employees work for an employer that calculates pension contributions on all earnings, not just the minimum required qualifying band of earnings. And half of employees work for an employer that offers matched contributions to some or all of their employees. That's where they put in more if the employee puts in more than the default level themselves. However, there are some quite big variations in this under the surface when we look by employer size in particular. So we can see here that larger employers in the dark grey bars here are more likely to offer more than the minimum 3% employer contribution to their employees' pensions, with around half of large employers doing so compared to only a quarter of small employers, so quite a big difference. They're also much more likely to make that contribution on all earnings rather than the qualifying earnings, and to offer matched contributions. So those three factors combined act as a triple boost to employer pension contributions for those employees who work for larger employers, and which those working for smaller employers are much less likely to benefit from. And we also see that employees who are in manual roles, lower earning, those with shorter tenure, and this really reflects the findings in the living pension research, are much less likely to receive more than the minimum employer contributions. So in the set of bars on the right here, we can see that whereas 4 in 10 employers offer more than the minimum contributions for all their employees, that drops to 2 in 10 of those who say they have mostly manual employees, and those who have mostly low to moderate earning employees, and around 1 in 10 of those whose employees have mostly shorter tenure. And we see the same pattern in the bars on the right if we add in those who do more than the minimum for some but not all of their employees. So looking at the ways in which employers differentiate between their employees and their pension contribution models. So some employers offer a uniform model for all employees, but other employers do differentiate in different ways between groups of employees. And it's clear that where that happens, the current models are often directing any of those higher than minimum employer pension contributions to employees who are likely to already have greater financial security, or to be more confident and active. And that happens in a couple of main ways. So the first is matching, which is kind of quite a dominant and established model for employer pension contributions. And we found that 1/3 of employers offer match contributions to all their employees, with a further 17% offering matching to some of their employees. And it's worth reflecting that this contribution model only rewards employees who are more financially confident and also who can afford to contribute more. The second way that this happens is that when we look at the employers who offer higher than the minimum contributions to some but not all of their employees, the most common reason for doing that, or the most common way of differentiating between those groups, was seniority, where a higher contribution is made by the employer for employees at certain levels or in certain roles. We saw this sometimes in the way that employers describe their different schemes or their different models. They'd say, we have this for management and this for shop floor, or they're quite often differentiating in that way. And 3 in 5 of those employers who do more than the minimum for some employees report seniority as the top factor for doing that. So although the baseline has been raised, there are some inequalities in the way that any above minimum contributions are distributed. And we thought perhaps it's time to reflect on why things are that way and how they might evolve. What are some of the drivers of the current employer pensions contribution landscape? And why do we see that the kind of different contribution levels and models that we do? So legal compliance is the most commonly cited factor driving employer pension contribution levels, and just over half of employers report legal compliance as a factor that's driving their organisation's pension contribution levels. And that's by far the most important factor driving pension contribution levels, in particular for smaller employers. And then affordability is also, unsurprisingly, an important driver of employer pension contributions, with 1/3 of all employers saying minimising financial costs to the organisation was a key driver they considered when setting contribution levels. And then when we look at those who are contributing the minimum for all their employees, around half of that group say that's because they can't afford to contribute more than that, and around a quarter say that it's because they prioritise putting money into base salary. And as Karen said when she introduced the session, we can probably expect that affordability has become more of a concern for employers since we conducted the survey, as they experience what some are calling a cost of doing business crisis alongside their employees grappling with cost of living challenges. But it's important to understand that affordability is not the only factor driving employers to contribute at the minimum levels. And we were particularly interested to see that when we looked at the group of employers who are offering the minimum contribution to all their employees, nearly a third of them said that that's because it's the amount recommended by government rather than the minimum amount set. And I think we know that employees sometimes interpret minimum contribution levels as a recommendation, but I'm not sure we've understood how powerful that interpretation is for employers as well before now. And then in addition to that, 1 in 5 of those doing the minimum said they were driven by the default setting in their payroll software or their pension provider setup. And indeed, 1 in 20 didn't know that it was actually possible to contribute more than 3%. So just to recap, this is just the group of employers who are doing the minimum for all their employees. But I think this does perhaps suggest that there is some potential to disrupt these quite strong defaults, where affordability isn't a concern or where reviews are happening. For example, by building nudges to consider alternative approaches or alternative levels in the systems and platforms that employers are using to manage their pension contributions. And then when we look at organisations who do offer more than the minimum 3% for some or all of their employees, we find that the main reasons for doing that are retention, supporting employees to save for retirement, and recruitment. But although just over half of employers say that wanting to support their employees to save for retirement is a reason for contributing more than the minimum, very few of those who do so have actually modelled retirement outcomes to understand whether the money that's going in equates to an adequate retirement in later life for their employees. Only 6%, we can see down the bottom of the chart here, have done that. And I think, again, we know it can be difficult for employees to understand what their contributions today mean for their retirement income, but perhaps that's also difficult for employers, and perhaps more support would be needed if employers were to take this into account when making decisions about their contributions approaches. And I think that's where something like the living pension, which focuses on what needs to go in to get to an outcome in retirement, could be really helpful for getting employees to adequate retirement outcomes. Another important factor that underpins employer approaches is beliefs around how best to target any additional investment in pension contributions. And we can see there's quite a divergence here in views. Employers seem to be really split over whether to target pension contribution spend equally across the whole workforce, just at those who need it most, or just at those who are most engaged. So whilst around a third of employers said equality would be a top priority if they were to implement a new approach, around 1 in 5 employers said that boosting retirement saving for those on the lowest incomes would be a top priority, and a similar proportion that contributing more for those who are most engaged with retirement saving would be a top priority. And the quotations here sort of reflect these different perspectives. There is perhaps a growing focus on equality in light of increased scrutiny of executive pay by investors and more broadly in society. And we certainly heard employers reflecting a desire to get to a more equal approach in our interviews. And there may also be a greater focus on how to target those most in need as a result of the current economic context. So, for example, with some suggesting pound amount top-ups to pension contributions for lower earners to get to those sort of minimum levels that Felicia outlined. So how feasible would future change actually be? Lastly, we're going to take a look at the potential for evolution in pensions contributions. The first thing to say is that employers see very limited opportunity to make changes to existing pension contributions and models. So nearly 2/3, 62% of employers say that their organisation is unlikely to implement a different approach to pensions contributions in the next 2 to 5 years, and that rises to 3/4 of smaller employers. And there are lots of reasons for that. The current challenging economic context, the inflexibility of legacy systems like payroll systems, the complexity of some employers' pensions provision, all of those things act as really strong barriers to change, even where there might be an appetite for enhancing or changing the existing model. So there's a quotation here: the cost of any payroll change is staggering. We could only do something in future if there was a wholesale system change, if the bonnet was already up. It's just too difficult to make a change because of the structural constraints. And then many individuals responsible for pensions decisions, particularly in smaller organisations, lack the knowledge and confidence to consider doing anything other than the default contributions. And it's really important for those of us who spend a lot of time thinking about pensions and pension contribution structures to remember that managing the pension scheme is often a very small part of the role for these individuals, or possibly not even part of their role, and therefore given little consideration beyond initial auto-enrolment compliance, getting it set up in the first place. And that quite often may be dealt with externally by an accountant or a bookkeeper. Additionally, retirement outcomes are seen by most employers to be mainly the employee's responsibility. So we asked survey respondents to rank who is most to least responsible for an employee's financial security in retirement out of the employee themselves, the employer, and the government. And 60% of employers consider the employee to be most responsible for ensuring they have a financially secure retirement. 20% said the government was most responsible, and only 13% that the employer was most responsible. And it's also worth reflecting here that smaller employers are the least likely to see their role. So 63% of small employers think they're the least responsible of those three, compared with only 28% of larger employers thinking that. And I think one reason for that is that employers we spoke to often sort of felt that they could only make a limited difference to retirement outcomes when employees might be with them for only a year or two and potentially have many other jobs in their working life. I think it's worth bearing these perceptions in mind, particularly when we think of proposals that ask for an equal split in contributions. For example, calls for 6% employee and 6% employer contributions, with the bigger increase from today's levels actually coming from the employer. You know, that's not here how we see employers seeing that responsibility. However, there were quite high levels of interest in different contribution models, despite those barriers to change. We explored a number of different approaches in this research, and the one that was seen as having the highest potential to boost contributions was a wider adoption of salary sacrifice in pension contributions. And that was particularly true amongst smaller employers, but around 2/3 of all employers said this approach was appealing to their organisation either now or in future. And that's probably not surprising. The model offers a win-win with savings on national insurance for both employers and employees. But currently 45% of employers don't offer a salary sacrifice pension arrangement or don't know they do, and that rises to 73% of smaller employers. It is worth noting that this model can be quite complex to implement, and it may not be suitable for all employees. However, it does emerge as having potential to boost employee financial security, because potentially those tax savings could be added to pension contributions to amplify retirement saving. There were also quite high levels of interest in using defaults and nudges to support employees to save more, including things like auto-escalation approaches and higher defaults with the option for employees to opt down. And these approaches could either work in conjunction with employers making higher contributions, but alternatively, they could provide ways for employers to do something to support their employees without increasing their own financial commitment to contributions. And then we also saw quite high levels of interest in hybrid approaches that combine pension saving and other kinds of savings, such as in the sidecar model. And I think, you know, recognising that many employers are looking to support their employees' financial well-being in the short term as a priority, with an increasing focus on this currently. And in the current context, perhaps these sorts of solutions present more pragmatic opportunities for some employers to support their employees' financial security than actually increasing their contribution levels. And then finally, just to sort of try and leave us with the employer perspective in our minds as we continue the conversation, if employers were to implement a new approach to pension contributions, they said their top priorities would be giving employees flexibility, encouraging higher employee contributions, being affordable and simple to administrate. So it's clear that there is some potential for employer pension contribution models to work harder to support employee retirement adequacy. But I think it is really important to acknowledge that if new approaches are to be adopted at scale organically, the solutions will need to be designed to overcome some of these employer barriers and to support employers to support their employees in ways that are seen by them to be straightforward and affordable. Thank you.
Thanks very much, Jo. So now we're going to come on to a few respondents. So first I'm going to hand over to Amelia, and very keen to hear from you, your reflections based on what you've heard so far this morning.
Thank you, Karen, and thank you, Jo, and to the Nest Insight team. A really useful piece of research that I think we'll definitely be looking at in the interim and over the future months and years. I guess from a small business perspective, you know, be unsurprising to many, that's quite a challenging time at the moment for many small businesses. But many small firms have a positive attitude towards AE. They've successfully gone through the staging process. They've responded positively to increases in employer contributions. But we do recognise that employers are absorbing employer pension contributions alongside other employment costs. And although they are committed to kind of supporting their staff in terms of financial well-being, there's a slight difference in terms of sectors as well. So I think Felicia was talking about the various sectors, whether from financial services to retail, and we definitely see that within our own membership. That more likely if you're in financial services, you're probably more likely to offer a better pension scheme than a business working in operating in retail or hospitality. And we see from our own research that 20% of small business owners cite rising labour costs as a cause for rising operating expenditure. So there are key challenges there. And from our own research as well, we can see from 2011 that employee-related costs have been on an upward trend, and this is likely to continue as policy develops. So I guess from our perspective, when we're looking towards the future, there's a lot of uncertainty at the moment for small businesses. Unsurprisingly, small business confidence is pretty low at the moment. Small businesses are quite unsure about whether they should invest in their businesses. They're just generally quite cautious about the general mood at the moment. I think Karen mentioned it earlier in terms of the ongoing energy crisis, and this is something that we've been looking at quite specifically at FSB, because it has a big impact on our members and the viability of their businesses. So we can see that nearly 1 in 4 have cancelled or scaled down plans to invest or expand in their business, and 6% of small firms have acquired business debt in relation specifically directly to energy costs. Now, what does this mean for kind of the employer landscape in terms of increasing pension contributions? Essentially, it makes it further down on the priority list for employers. We do know, and many of us have seen over the last few months, the kind of recruitment challenges that many businesses have faced, and that 78% of small firms have cited that they have found it very difficult to recruit staff over the last 12 months. The most common response to those difficulties has actually been to increase salaries. However, we don't know whether that has led to an increase in kind of deferred payments. Most likely, from what we see from our anecdotal evidence, it shows that employees or applicants are really looking for increase in pay as opposed to deferred payment. So there are kind of big people issues, as we know, but also from our kind of small business index, the quarterly survey that we carry out, we found that the majority of small firms expect no or negative growth in the next year. And at the same time, 89% of small firms are telling us that their costs are even higher than a year ago. So it just means having these conversations about employer pension contributions are really difficult at the moment with the current pressures that small businesses in particular are facing. But definitely I think employers have a role to play in supporting increasing minimum contributions. And we know from the previous report from government back in 2017 that there were various proposals as to how government can increase AE in the future. One of which we definitely support is kind of reducing that age eligibility for AE. I think that's an important step that could be made prior to looking at increasing employer contributions. FSB also supports the Nest SciCard savings model, which allows employees to build up a pot of liquid emergency savings alongside their retirement savings. And I think Joe's also mentioned kind of compliance as well, which is a key part of it. Kind of ensuring that the system is simple and easy to navigate for small employers is crucial. Many of our members don't have HR support within their business. They're very much reliant on payroll providers. So going back to Joe's point about their kind of reliance on those default assumptions that government has told them to do X, therefore that's what they feel that they should do, but also the fact that they're often relying on their payroll providers, their accountants, to kind of direct them as to what they should do. So a lot of support needs to kind of come from them, those individuals, in terms of payroll, ensuring that any future changes don't come at a higher cost for employers. The pensions regulator also has a big important role to play in supporting small and micro employers, and this is something that we've definitely seen over the last few years with small and micro businesses, ensuring that they're able to kind of meet those compliance requirements on the journey. And it's also, I couldn't come on this panel and not talk about the self-employed, pensions for the self-employed, something that the government talked about a few years ago, but we've yet to see kind of real change or any kind of policy direction from government. So I think be very key to, as we talk about the changes in terms of AE, but also look at pensions for the self-employed. And kind of just going back to some of the comments that have been made earlier, I think that is quite difficult for smaller employers to kind of think about that bigger piece in terms of offering increased pension savings. I know Joe talked about whether small employers have a responsibility, whether they feel it's their role to increase employer contributions. When I was preparing for today's event, I kind of thought back to a conversation I had with a member during the pandemic before the furlough scheme was announced, and they contacted FSB because they simply had run out of money, or they were running out of money. They'd run a small cafe, and this was before furlough was introduced, and they wanted to know how they could support their staff getting onto universal credit. Now, the employer didn't necessarily have a role, a responsibility to do so, but I think it just showed the care and concern that they were aware that their ability to pay staff in the short term was quite difficult, and they wanted to try and find a way to help their staff. So I think that sentiment still remains, both from an employee perspective in terms of meeting the current challenges of the cost of living crisis, but also in terms of ensuring that they have inadequate savings in retirement. So lots of interesting findings from this report. As I said, I'm definitely sure we'll be going back to it, especially from the small business research aspect. Thank you.
Thanks very much, Amelia. And yeah, I think, it's a point well made that there is a lot of goodwill from employers about wanting to support these things, but being honest about the scale of the challenges that they're facing as well. So I'm going to come lastly to Lawrence. So yeah, Lawrence, a few reflections from you, and then we'll come on to the Q&A.
Sure, thanks, Karen, and thanks, Joe and Alicia, for those presentations too. They were really interesting, and yeah, definitely looking forward to getting into that in the panel discussion. Just a little background to me. I work in the changing workforce team at CBI, where we focus on pensions issues, typically with a focus from the sponsor or the employer's perspective. CBI is the largest trade association in the country for businesses, with 200,000 members across the spectrum of UK business, including SMEs and large businesses. I know Amelia's already touched on sort of SME perspective, so I will try and major on the larger employers as we go through. So where to start? I know I've said this separately to you before, Joe, but this report is real gold dust for me and for, I'm sure, Amelia and any other trade body as well representing businesses, because it really reflects a lot of things that we've been hearing anecdotally from our members. Yeah, before we get into the detail, I think it's probably good to just take a step back and highlight the real good evidence out there that employers see both a strong business and moral case for providing good workplace pensions. Typically, where they can afford to do so, businesses do go above stat minimum already for both those moral and economic reasons. And I think it's probably no coincidence that your report suggests about 51% of employers can't afford to contribute more than the 3% at the moment, and that's exactly the same percentage as those that don't already. So yeah, just thought that was really interesting and worth highlighting. Specifically for large businesses though, I think it is in a sense easier thanks to their economies of scale and that capacity for longer term strategic thinking about employee value proposition and how they can best maximize that. Notwithstanding that, there's a lot of good things in the report, Joe, about the logistical difficulties that large employers face as well. That does make that harder. But in practice, what we hear from our members is because big employers have those economies of scale, because they're planning 10, 15, 20 years ahead, where when they know they will essentially still be around at that time, they can take a far longer term view of pensions and what they're contributing. And at the moment, well, I think for both large and small employers, it does come back to this balance between affordability and the moral and business case for providing good workplace pensions. Yeah, on the one hand, we have very tight labour market conditions, and importantly, a large number of older workers that have left the labour market over the crisis. So there's more of an impetus from that for business to look at their pensions offer as a way to boost their attractiveness and the retention specifically of that older cohort, who you might want to attract back into the labour market, or you need to hold on to keep their skills. But on the other hand, the affordability, and I'm not going to cut across a lot of what Amelia says because it also applies to large businesses, but the affordability right now is a big problem. And I think actually some of the reports data on businesses saying that they pay statutory minimum because of legal compliance might be quite a good proxy for this, because if a business has to take a cost minimization approach to its pensions offer, that will inevitably mean that they have to try and get only to legal compliance level. So yeah, we are hearing day to day a lot from our members about the current economic conditions that they're operating in. And I think that pendulum is probably swinging towards unaffordability right now over the next few years. And even where a tight labour market will continue to be with us, it still seems quite unattractive from an employer's perspective to keep offering increasing contributions in the current environment. That's not to say that in 5 years' time it might be more possible to relook at statutory minimums and think about how we can really push up that contribution level from the employer. But right now we're in a very concerning place, even relative to just a year ago. We just surveyed our members and found that 59% of them are seriously concerned about their current labour costs, compared to just 34% in 2021, and that was already quite a high, scary stat for us. So yeah, picture is changing quite a lot, I think. Yeah, but because of those tight labour market conditions, many are also thinking about how they can be maybe more clever in their pensions offer, and looking at ways that allow them to put forward a package that might be more suited to tight labour market conditions where they want to appeal to older workers, but where increasing costs might make that a struggle to do across the spectrum. I think the data on matching that you mentioned, Joe, is quite interesting there. It's no surprise to me at all that so many businesses, I think it was 50% in total, apply a matching strategy, as that would appeal far more to attracting older, more senior workers that have left over the course of the crisis. So I think that would make a lot of sense. There's also an increased focus on how pensions can be used, or just wider financial well-being can be used to provide support to those most at the struggling end of the cost of living crisis. Again, we just surveyed our members, and 9% of them are continuing to provide their contribution for those employees that choose to opt out of their pension at the moment. And that's reflective of trying to take an approach that targets help where it's most needed. I suspect that side of things is going to explode in the next few years as well. There's a really good Willis Towers Watson piece of research that's been released recently as well that said those organisations with a formal financial wellbeing strategy is expected to rise from 17% today to 94% within just 2 years. And a lot of that will be about how you can support pensions and saving for long-term retirement, as well as day-to-day financial well-being over the cost of living. Yeah, and I think that marries well with the data you mentioned, Joe, about interest in sidecar salary sacrifice schemes and auto-escalation and other hybrid approaches. Lots of reports from our members that they're looking at these options. I'll just highlight a couple of challenges there that have come back. Certainly around default sidecar savings, there's a huge amount of interest, but a lot of worry that there isn't really the market precedent out there for it yet, or the legal precedent certainly for default opt-in systems, and there's potentially something that government could do there. And also in the current environment where you have a very tricky economic backdrop, the optics of trying to put forward a big financial well-being package are very difficult to navigate if business isn't also able to offer real wage matching increases to pay, which is ultimately what employees care most about. And probably where I should end is that's probably the elephant in the room here. Ultimately, it's real wage growth that's going to drive output for firms, but also pension savings. And I think the only way long-term we can look to both ensure short-term and long-term financial well-being is to ensure that we get productivity growing and with it real wages growing as well. So I'm sure we'll get into that in the Q&A. But yeah, thanks for inviting me and thanks for a really good presentation.
Thanks very much, Lauren. Yeah, very helpful to hear again, about the very difficult context that we're in. So we've got a few minutes for questions, and we've had a few coming in. So I'm actually going to start with where you ended, as it were, Lauren, which is we've had a question of basically, should we be focusing on wage growth rather than pension growth? Because obviously, if pension contribution rates remain the same, then if wages go up, pension contributions will go up as well. So given all of the pressures that we've just been discussing, is that where we should be focusing? So I'd be very keen to hear everyone's thoughts on this. I think perhaps I'll start with Felicia, if you don't mind, for your perspective, and then come again to the rest of the panel.
Sure. So like Lawrence said, I definitely think ultimately it's important that we do also include wages as part of the solution and the answer to what we are proposing in terms of what we would like to see in terms of pensions. So and this is because from both of our analysis from RF on a living pension and from the NEST report, the employers' likelihood of even achieving the living pension is largely not only down to the industries in which they work in or the type of employers that they work for, but ultimately how much they are paid. So lower paid workers are essentially the least likely to even meet a living pension, and therefore it's really important to address the wage situation when we're thinking about pension and future living standards.
Thank you. And if I just come to Joe, based on what you heard from employers during the research, what do you think about this kind of balance between wages and pension contributions?
So I think we certainly heard from many employers that their immediate focus is on pay today. And I think we see in some of the answers that prioritizing pay today is kind of coming first. I think where we see this working really well, talking to employers, is where employers are able to really understand their employee population and to think holistically about employee financial well-being. And there are some really good examples of employers doing that and putting together a package that thinks about both pay, but also support for savings, support for access to affordable loans. And I think also there being different kinds of support for employees that are on different stages of a journey towards financial security. Now that is probably not within reach for all employers. And I think one of the things that we're starting to look at is how do you take best practice like that and scale it for smaller employers who don't have someone who is responsible for reward or employee financial well-being. I think as well there was one example I remember of an employer I spoke to who very much think about this when they look at pay, and they actually work out what the kind of settlement is for the year for pay, and then they split it between pension contributions and pay. And I think that's a really good example of an employer sort of trying to balance short term and longer term. Clearly at the moment the focus is very much on the short term, but I think as you set out at the start, Karen, we can't forget about the long term. So really challenging for employers, but I think there are other things that employers can do emerging from this report that are non-financial cost, or at least kind of lower financial cost, that support their employees in other ways.
Thanks very much. And Amelia, briefly from you, some thoughts from the small business perspective on this?
Yeah, definitely. I think we can see from our membership that members are thinking about pay in terms of the immediate term. So 30% are saying to us they potentially think they have to increase salaries in the future to ensure that they can recruit staff. I think it's really important when we're looking at wages increasing, that we also think about the support that employers can receive from the government. So FSB's long campaign for the employment allowance to kind of keep up with the rising national living wage. Most of our members, 54% of our members, pay above the current level of the national living wage before the increase in April of this year. So just ensuring that we have that support, and also thinking about the information piece that Joe mentioned. So another thing that we are in support of is a midlife MOT. So ensuring that employers, especially those at the small and micro end who don't really have that expertise, there is a vehicle that they can provide that information to their staff about financial well-being and other issues such as skills, etc.
Great, and I'm afraid we're rapidly running out of time, but just to give Lawrence a chance, if you had any final reflections, you said a bit about this in your comments, but any further thoughts from you on the wage versus pension contribution balance?
Sure, I could just clarify. I think that it's undeniable that raising statutory minimum contributions has had a huge impact on pushing employers into contributing more to pensions, and doing so again would probably lead to a similar result. But without real wage and productivity growth, you've got to be real about the opportunity cost that will be lost there, because that is ultimately investment that could be going to other parts of a business. So yeah, I think you can shoehorn up increasing contributions through statutory minimum increases, but ultimately without productivity growth, that's going to be damaging to the rest of the EVP and the rest of an employer's future prospects in UK PLC as well.
Thanks very much. So yeah, unfortunately, we don't have time for any more questions, but thank you very much to all the brilliant panelists. A lot of food for thought, I think, to begin the week, hopefully. So I hope everyone enjoyed it. And yeah, thank you to everyone who joined us today. And if you have further questions about the research, please feel free to get in touch with the Nest Insight team. They'd be very pleased to speak to you. Thanks everyone for coming along today. And yeah, there's more information on the report available on the Nest Insight website. So have a good week, everyone. Thank you.